Thank you all for joining us this evening, and it's a huge pleasure to have Howard Marks with us this evening. Howard, we are very delighted to have you with us today. We have a room full of MBA students here on the INSEAD Fontainebleau campus, which is outside Paris. So we are very much looking forward to the discussion. It has been the mission of the Investment Management Club to strengthen the link with the financial community and INSEAD, and for these reasons, we are particularly delighted to have Howard with us today. We will spend the first half an hour talking to Howard about his investment philosophy over his career and how the lessons he learned over the past 5 decades apply to the environment we are facing today. There will be an opportunity for Q&A towards the end of this session. As a brief introduction, my name is Roy. I'm the co-president of the Investment Management Club. I'm originally from Israel and was a public equities analyst in the past. My co-moderator this evening is Andras, who is originally from Hungary and used to work in private equity investments.
Thank you, Ryan. Now, most of us are very familiar with Howard's work, but I thought there could be no better way to introduce Howard than a quote from Warren Buffett, who once said, and I quote, "When I see memos from Howard Marks in my mail, they are the first thing that I open and read." So Howard went to Wharton for undergrad and then received his MBA from Chicago Booth. He started his career as an equity research analyst at Citicorp, and then focused on convertible and high-yield bond investing. And from the mid-1980s, he was one of the pioneers of distressed debt investing as an asset class. In 1995, he founded Oaktree Capital Management, and he is the co-chairman of the firm today. Over the years, Oaktree has grown to become one of the most distinguished alternative investment management houses, with over 1,000 employees globally, more than $170 billion in assets under management, and of course, a stellar investment performance over the decades. Howard, among many other things, is a prolific writer. He has written 2 books and is well known for his memos that he has been regularly publishing all the way since 1990. In his memos, he shares his views about the investment landscape and his broader business philosophy. And his memos are always seen by everyone in the finance community as a very valuable resource. If you're not already subscribed, then I highly recommend that you go to the Oaktree website and add your name to the mailing list right there next to Warren Buffett's.
Okay, so turning for the first questions, if it's okay with you, Howard. So we would like to ask, you have seen a lot probably during the past 5 decades, and we were curious if there were any events or experiences that made you rethink your investment philosophy, like key events that made you rethink your philosophy.
Well, Roy, there are probably more events than I can mention. Partially because I don't have enough time, and partially because I'll forget a few. But I learned one of the very most important lessons very early in my career. And by the way, number one, we pretty much only learn from our failures. We don't learn much from our successes. And number two, it's very desirable to learn the lessons early in your career when you have time to correct your mistakes and when you don't have too much money to lose. But, you know, when I started at Citibank as an equity analyst, it was September of 1969. And the bank and most of the, what we called the money center banks, the big city banks, followed what was called the Nifty 50. And these were the 50 companies in America, roughly 50, wasn't a precise number, who were believed to be the best and the fastest growing companies. Number one, companies so good that nothing could ever go wrong. And number two, companies so good that there was no price for their stocks that was too high. So if you bought those stocks the day I got to work in 1969, if you held them for 5 years firmly, if you were really resolute, you lost almost all your money. And in the best companies in America. Why? Number one, a bunch of these companies where nothing was supposed to be ever go wrong, something went wrong. And number two, people thought there was no price too high. Well, guess what? The prices were too high. And these stocks sold between 60 and 90 times earnings. And 5 years later, they sold between 6 and 9 times earnings, which is an easy way to lose 90% of your money. So this came as quite a shock to everybody who had thought that these things were bulletproof. And by the 1975, I had become director of research. So I was part of the senior management of the group, and a firm adherent to the Nifty 50 approach. And so a new chief investment officer came in 77, and he wanted to bring in his own head of research. I don't blame him. So he says to me, well, I'd like you to go to work in the bond department and start a convertible bond fund, as you mentioned in the introduction. And the bond department was Siberia. But I went ahead and did it because I was intrigued by the idea. And of course, in August of 78, I got a call from the head of the bond department saying, there's a guy named Milken or something out in California, and he deals in something called high yield bonds. Do you think you can figure out what that means? And I said, yes. Now I'm investing in the worst public companies in America, and I'm making money steadily and safely. So this was really formative for me. What does it teach you? It's not what you buy, it's what you pay. That investing success doesn't consist of buying good things, but buying things well. And I don't know how many people there, English is their first language, but you better understand the difference or you're in big trouble. What I came to understand is that what matters most, well, not most, but what matters is that if you buy something, that things have an intrinsic value. And by the way, when everybody was dealing with the Nifty 50, nobody was thinking about intrinsic value, in particular because they couldn't estimate the earnings 20 years out, which is, of course, difficult. But if you buy things for less than their intrinsic value, you're probably on your way to a good outcome. If you pay more than intrinsic value, you're going to have to work very hard and get lucky to make a decent return. So this was really important. There have been other lessons along the way. I think one of the most important ones, it didn't stem from a particular event, but rather mostly from reading a book called The Short History of Financial Euphoria by John Kenneth Galbraith. And what it was really an exploration of bubbles and manias. And what it impressed me with was the importance of understanding investor psychology. The economy goes along. In a good year, it's up 3. In a bad year, it's up 1. Corporate profits increase. Sometimes they're up 10, sometimes they're up 5. The stock market fluctuates wildly. The element behind the fluctuations is not changes in the fundamentals, but changes in investor psychology, which are just wild. So you better understand investor psychology. You better understand what psychology is embedded in the price of the asset you're thinking about buying. If you buy something that's the subject of great optimism, and if that optimism is embedded in the price, which it invariably will be, since the optimism is widespread, then it's going to be hard to get a bargain. And if you buy something which is out of favor, like today they say that China is uninvestable, maybe there's no optimism, in which case the price is not high relative to intrinsic value, and maybe the surprises are going to be on the upside. So I think that understanding psychology, and so you mentioned the book Mastering the Market Cycle. That's mostly about psychology. I mean, the most important stuff is about psychology, and understanding where you are in the cycle, and thus what psychology is embedded in asset prices is extremely important. So these are just two of the thousands of lessons that I learned over my career, and I hope to learn more in the next 50 years. But these are two of them by far the most important.
Thank you very much. About 20% of the INSEAD student body is a native English speaker, and the remaining 80% is not. But I think those lessons resonate with all of us.
Well, I think it has something to do with the difference between bien and bon.
We will get back to investor psychology in a little bit, but I just wanted to ask you about your memos in particular, which you have been writing for 23 years and counting.
How about 33 years? You got to work on the
sorry,
math.
my maths was way off. 33.
By the way, math is very important for people who want to be investors.
Noted. A valuable lesson as well. Can you tell us what inspired you to start writing and how your writing style has evolved over the years? And in particular, what advice would you give to young professionals who will be producing a lot of written content, sharing their own investment views? How can we communicate effectively in this medium?
Consistent with how I do most things, the decision to write the first memo was not the result of some thought out plan to write them periodically, to enhance the value of our business, to get new clients. The reason I wrote it is because an event occurred, or two events occurred, the combination of which pointed to a valuable lesson that I wanted to share. I had dinner with a client, pension fund, and the guy who I had dinner with had been running this fund for 14 years. And in the 14 years, he was never above the 27th percentile or below the 47th percentile. So for 14 years in a row, he was solidly in the second, did I say quartile? I mean percentile. He was solidly in the second quartile. And so if you range between the 27th and the 47th percentile, where do you think you are for the whole period? Well, you might say 37th percentile on average. The answer is, for this particular fund, 4th percentile. How can that be? If you're solidly in the second quartile, 14 years in a row, how can you be in the fourth percentile for the whole period? And the answer is that in investing, most people eventually shoot themselves in the foot. Most people blow it. They make some risky investment and it explodes, and they have to start rebuilding their record. So I said, well, that's a great thing. So, in other words, you can succeed by being a little bit above average consistently and by avoiding disasters. And then when I got back to New York, it was a tough year for value investors. And there was a deep value firm that had a ton of investments in the banks, which are the classic deep value stocks. And the banks did terribly that year. This firm's accounts did terribly. So the president comes out and he says, well, it's simple. If you want to be in the top 5% of money managers, you have to be willing to be in the bottom 5%. And my reaction was, I don't want to be in the top 5%. My clients don't care if I'm in the top 5%. And they absolutely don't want me to be in the bottom 5%. I like the first approach better. So I wrote this memo in 1990 called the Route to Performance. That was number one. I didn't have a plan to write number two, but a year or so later, I had another idea. So I wrote another memo. Now it was about the swing of the pendulum between optimism and pessimism and fear and greed, psychology. And then I wrote another one about the value of predictions, which personally I don't think is very high, and so forth. And so I've been writing them now for, you can do the math, 33 years. And, it's been a lot of fun. It's my creative outlet. I look forward to doing it, and I'm always happiest when I have one in the works. I want to mention for everybody in the audience, when they think about how they're going to conduct their careers, that in the first 10 years, I never had a response. Not only did nobody ever say, "Oh, that was great, I enjoyed that memo," nobody ever said, "I got it." I thought I was writing to myself, but I enjoyed it, so I kept doing it. And then 10 years later, on the first day of 2000, I published a memo called Bubble.com about the craziness involved in the tech bubble that had consumed the late 90s. And that memo was very correct, very quickly, which are the two important criteria. And then, as I describe it, I became an overnight success as a writer. Now, you asked how I write. To me, my approach to writing is to write the same as I speak. And a lot of people say, "Oh, I can't write. It's terrible to write. It's very difficult to write, blah, blah, blah." Just speak. Maybe speak into a tape recorder or into a computer that transcribes it. And put out written product that sounds like you're talking. And if you can speak clearly, you can write clearly. And if you can speak convincingly, you can write convincingly. And so I've always tried to make my memos sound like a conversation. The interesting thing is, of course, now in the last 5 or so years, now they go out on podcasts. So now we've come full circle because somebody is actually saying the things that I write, and I write them like I'd like to say them. The other thing is, my goal is always to simplify. A lot of people try to look smart in the things they write, use big words, complex concepts, Greek letters, subscripts and superscripts and all that stuff. And I just try to make things clear. And I get a lot of mail nowadays. Of course, that's the benefit of the email. But two things make me very excited. People say, "You made a complex subject clear." And nowadays, I get a lot of mail that says, "You changed my life," because I've adopted a lot of your philosophy, and that's really a thrill for me. So it couldn't be better. And now that I'm a little older and I've given up some of my day-to-day responsibilities, the writing is a very big part of my professional life.
That's great. It's so fascinating because so many of us are readers of or your memos or the books. Usually you write about psychology in investments, and you just mentioned the topic of avoiding mistakes, fatal mistakes. So we were curious those days. We see some things like there was this overvaluation in tech, or the rising inflation, things that people couldn't really foresee. And we are curious about, you write a lot about groupthink and about the danger of the danger of not being contrarianist or a conventional wisdom. And sometimes we wonder, when is the consensus? When should we know that the consensus is wrong, or when should we avoid just being contrarianist for the own sake of being a contrarianist?
You absolutely cannot be contrarian for the sake of being contrarian. And my first book was called The Most Important Thing, and there was a second edition called The Most Important Thing Illuminated. And Columbia, which published the book, asked some people in the investment business to supply commentary connected to certain spots in the book. You're reading it on Kindle, you come across a dot, you hit the dot, you get a comment from somebody. And my friend Joel Greenblatt, who was an exceptional equity investor, when I was in the section discussing contrarianism, his contribution was to say, just because 5 other people refuse to stand in the path of an oncoming truck doesn't mean you should. So you can't be contrarian just to be contrarian. A lot of the time, the consensus is as close to right as you can get. And it may be wrong, but you're unlikely to be able to improve upon it. So you can't say, I'm going to do the opposite of the crowd. What you have to do is you have to say, this is in the book, I think. You have to say, what is the crowd doing? Why are they doing it? What's wrong with what they're doing? What's wrong with their motivation? What should you do instead? And hopefully that will lead you to being an effective contrarian. I mean, the point is, Roy, you have to, at some point, think differently. Because the goal of an investor is not to be average. The goal is to be above average. People who are average are not going to find great success. And in fact, in the stock market, people who are average can be replaced by an index fund. So the goal is to be above average. But clearly, to be above average, you have to know something most people don't know. You have to see something people don't see. You have to have an expectation that most people don't share. You have to find an error taking place in the market that most people overlook. I wrote a memo called Something of Value in January of 21, and it was about the time during the pandemic that my son, who's a very talented investor, and his family were locked up with us together. And it was fabulous for the two generations, or actually three generations, to live together. And a lot of the memo was about value investing and what's wrong with the ossified is a good English word for you. What's wrong with the hardened siloing of value from growth. And one of the things he mentioned is that, and I never exactly thought of it this way, is that readily available quantitative information about the present cannot hold the secret to superiority, for the simple reason that everybody has it. And if you're going to be superior, you got to think differently from others, and you have to know something that others don't know. You have to have a variant perception of something. You have to either do a superior job of interpreting that quantitative information, or you have to do a good job of understanding the qualitative information that matters, or you have to have a better view, a more accurate view of the future. You have to have something that distinguishes you. So, you know, in Most Important Thing, the first chapter says that the most important thing is second level thinking. What does that mean? The first level thinker says, you know, we should buy General Motors stock. It's a great company. The second level thinker says it's great, but it's not as great as most people think. There's excessive optimism in the price. We should sell it. See? And the second level thinker thinks more deeply, more nuanced, and understands what's wrong in the thinking of the first group. So when Andrew was in college and he would come home and he would say, oh, you know, got to buy General Motors stock because they're bringing out a great new Mustang and everybody's going to want it. My answer to him was always the same for rhetorical, platonic purposes. I would say, who doesn't know that? If you know something that you think is important, but everybody else knows it, then it's probably already in the price of the stock. So knowing it doesn't give you an advantage. Very important to have that knowledge advantage and to think differently than others. Again, however, not for the sake of being different. It has to be reason-based, but it can be done.
Thinking about where we are today, I mean, you have written about the sea change that you're seeing in the landscape, which is only the third major realignment of the landscape that you've seen over the course of your career. And I think many of us here coming to the end of our MBA program feel that the world that we're graduating into is very different than what the world looked like when we started. So my question is that as an investor, where do you see opportunity in this environment and what worries you the most?
Well, I don't imagine there are many people in the room who were alive in 1980. But if you came into our business since 1980, for the most part, you have only seen times when interest rates were either declining or ultra low. In the memo, I talked about the fact that I had a loan outstanding from the bank in 1980, and they sent me a slip of paper saying the interest rate is 22 and a quarter. In 40 years later, in 2020, I was able to borrow at 2 and a quarter. This 2,000 basis point decline of interest rates over those 40 years had a profound effect on investors and investing. When interest rates come down, the discounted present value of future cash flows goes up. That is to say, assets become more valuable. Business is strong. Relatively few people default or go bankrupt. Borrowing becomes cheaper, so that leverage strategies become more profitable than one expected. All these good things happen in a declining interest rate environment. Of course, it's hell on savers, retirees, lenders, and so forth. But this describes the 40 years. More particularly, it describes the 13 years from the beginning of 2009 to the end of 21. In the beginning of 2009, the Fed took the Fed funds rate to zero in order to fight the global financial crisis. And for me, inexplicably, they kept it there for 7 years. And once in a while after that, they tried to raise rates to get them back to kind of more normal levels. But the market expressed its dissatisfaction and the Fed chickened out. And you can see that in particularly in the fourth quarter of 18 and January of 19. In the fourth quarter of in 18, maybe late 17, the Fed was engaged in a program of rate increases, and then the rate got up to 3 1/4, I think, in October of 18, and so the market freaked out. Market had the worst fourth quarter in history, as I recall. And in January of 19, the Fed reversed course and cut rates. So the point is that this was because of the low and declining level of interest rates, this was an easy period. Easy for company managements, easy for asset holders, etc. Now, if declining interest rates cause asset values to rise and the cost of capital to fall, then for somebody who buys assets using borrowed money, it's a double bonanza. And it should not come as a surprise that private equity did very well in this climate. So people sit around now and they say, well, private equity, that's a great strategy. It's a very successful strategy, makes a lot of money. Well, isn't it environment dependent? And if you think about it, I'm writing a new memo to follow up on sea change. And I say in there that I believe that well over 99% of all the buyout investments that have ever been made have been made since 1980. The private equity business, by the way, it was called the LBO business in the 80s, but all the deals did so badly that they had to make up a new name for it, so they called it private equity. But I'm not kidding. You can laugh, but I'm not kidding. I laugh too. But the point is that virtually all of the buyout investments we've ever seen have been made since 1980, which was the ideal period for buyouts. You buy it, and I say in the memo, you find a company you think you can make 10% a year if you buy it. So you buy it for 10%, and you try to make 10. But then you hear that you can borrow money at 8%. So you replace a bunch of your equity with money borrowed at 8. You're borrowing at 8, investing at 10. This is great. Then the declining interest rates make the company more valuable, so the return on the company is more than 10, and the declining interest rates reduce your cost of capital so that you have to pay less than 8. And now it's much more profitable than you expected. And people say to themselves, boy, I'm smart. But there's an old saying in our business, never confuse brains with a bull market. And if you're successful, you have to say, why was I successful? And if it was the fault of the environment, you shouldn't take the credit. You shouldn't deceive yourself. Anyway, that describes the period 09 through 21. Easy times, easy money. And now that it has been shown that accommodative monetary policy from the central banks produces inflation, now I think the central banks will have concluded that they can't be accommodative all the time. They can't engage in continuous stimulus. And so I think that rates are not going back to where they were. And I say, I don't believe in forecasts, especially my own, but I say in the memo that I believe that the Fed funds rate is more likely to be between 2 and 4 in the years going forward than between 0 and 2. In other words, we're not going back to those ultra low interest rates, which means it's not going to be as easy to make money through asset ownership or through borrowing or through buying assets with borrowed money. And I think this is a much better period for credit. And, roughly a year ago, high yield bonds yielded 4-ish, and to now they yield 8-ish. It's a great time to buy high yield bonds. Who knows the return on the S&P over the last 100 years? Anybody know that? Just over 10. So today you can get roughly 8.5 from high yield bonds, 9.5 from levered loans, 11 to 12, 13 for loans to the biggest senior loans, to the biggest buyouts. You can get equity returns from fixed income. And fixed income returns are clearly much more dependable than equity return. So why wouldn't you? This is a big change. And this is what the sea change memo was about. And this is what the new memo will be about, supporting.
It's very, very helpful. We think you talked now about, of course, macro forecasting. And, today, it feels like you really need to understand macroeconomics and in order to be a good investor. And we think you've been criticizing a lot of time you've been critical of macro forecasting, and we were curious about to which degree can we count on macro forecasting, because on the one hand it's very important, you obviously talk about it. On the other hand, it's very hard to forecast macro trends. So how do we balance that?
In January of 2016, I was having a dinner with Warren Buffett, and he says to me, for a piece of information to be desirable, it has to satisfy 2 criteria. It has to be important. It has to be knowable. The macro is very important, seems to be the thing that moves the market most, which is a change from 50 years ago, but it's not knowable. And if I asked you or the people in the class, name for me some successful investors. You got Buffett, you have Munger, you have Peter Lynch, you have Bill Miller, and you can go on down the list of successful investors. Now, give me a list of the macro investors who have been successful.
Only Soros.
Only Soros, that's right. Well, and his disciple Druckenmiller. But getting rich is overrated in terms of a gauge of a person's merit. But on the other hand, you have to say, where are the rich macro investors? And there are so few. And if you look at the performance of hedge funds, for example, which has been terrible in the last 20 years, there's a subsector called macro, and their results are even worse. So, I would say almost nobody has been successful at macro forecast. Now let's go back to what I said 10 minutes ago. To be a superior investor, you have to have a knowledge advantage. You have to know more than others. Who knows more than others about the macro future? Virtually nobody. So it may be important, but if it's not achievable, why waste your time on it? You know, and so I put out a memo, I think it was October, you would probably know better than me, Roy, called The Illusion of Knowledge, which I thought was a very important memo, because I've been talking, that third memo back in 94, I think, was entitled The Value of Predictions. And I didn't say it was very high, but I've been talking about the uselessness of forecasting for a long time, but I never explained why. And that's what that memo is about. Why is forecasting such a bad idea? And I'm convinced it is. You know, let's see. How can I explain it? Well, the title of the memo, The Illusion of Knowledge, comes from the historian Daniel Boorstin, who said that the enemy of knowledge is not ignorance, it's the illusion of knowledge. If you think you know something, then you're gonna sit on that and take comfort in that, and maybe you're wrong. The American humorist Mark Twain said, "It ain't what you don't know that gets you into trouble. It's what you know for certain that just ain't true." And the belief that you know is dangerous if the truth is that you don't know. And that's how you get into big trouble. So I'm firmly against it. Oaktree, I hope I don't insult anybody in the audience, but Oaktree doesn't have an economist. We don't invite economists in to give their talk. And one of the tenets of our investment philosophy is that our investments are not based on macro forecasts. It's right there, number 5 of the 6. And I believe in it extremely strongly. If you stick with rather the macro, economies, currencies, rates, commodities, market behavior, these things are not knowable in a superior way. But if you stick to the micro, if you work really hard, I believe you can get an advantage in some situations with regard to companies, industries, and securities. Those are the micro, and that's where you should spend your time, not trying to guess at what GDP is going to be next year.
Thank you.
By the way, one of the things I said in the memo is that the Fed has hundreds of PhD economists, and the Fed can't even predict what the Fed is going to do. Now, if it's your behavior and you publish a prediction, obviously you have it within your power to make it come true. And the Fed's predictions of its own behavior don't come true. So I would say, if they don't know what they're going to do, how the hell can any of you figure out what they're going to do?
Thank you very much. For the final 10 to 15 minutes, we'll open up the floor to the audience. And if you have a question, please raise your hand. The microphones will be disabled.
By the way, let me tell the audience that Roy and Andra wrote out about 15 questions. And the only reason we got to so few of them is that my answers are too long. But I'll try to give shorter answers on your questions.
Thank you. Thank you. Questions? Julian, go ahead.
Hi, Howard. Thanks a lot for your talk. So I'm an economist by training, but I'm in no way offended by your claim. I'm actually skeptical in my own field as well. I guess
with good reason.
One thing that economists tend to do is they have sort of quite wide bands of uncertainty in their forecasts. And that's
hold it. Let me turn up my computer a little bit. You said one thing.
One thing that economists tend to do is in their forecasts is they tend to have quite wide bands of uncertainty. And that's typically due to the fact that they sort of want to reflect the risks in sort of future scenarios. So I was wondering, given you don't have any economists at Oaktree, how do you think about risks in your investments?
Well, of course, the risks that we think we can profitably deal with are the micro risks, that the company does something wrong, that the product falls out of favor, that there's too much competition, that the cost of the raw materials goes up, that the management makes mistakes, that the new factory doesn't work or isn't needed. These are the or that the company becomes overlevered and can't get through a recession. Now, I'm going to make an admission to you. Having told you how terrible forecasting is, the truth is that every micro forecast requires a macro forecast. I can't make a prediction of earnings if I don't have an idea of what GDP is going to be in a future year. I have to know if the economy is going to be booming or cratering. So in some sense, my criticism of forecasting is a little bit hollow. But I think the important thing is that we make what I call neutral forecasts. We forecast that next year is going to be like most years, or like this year, or that if something's been growing at 2%, it's going to keep growing at 2%. A neutral extrapolation. Now, let's say we're talking about U.S. GDP and it's been growing about 2%, and everybody thinks it's going to keep growing at 2%. And if you think it's going to grow at 2%, that forecast has no value in terms of making money. But so somebody else in the audience there thinks it's going to grow at 4% next year, and somebody else thinks it's going to go down 2% next year. The one of those, and everybody else thinks it's going to be 2%. The forecaster who, among those two people, who is correct and acts on that, can probably make a lot of money with that forecast. We just can't tell which one it's going to be. And most of the time, forecasts of a deviation from trend, forecasts of the end of extrapolation, are usually wrong. So in order to make money from a macro forecast, you have to have a forecast which is non-consensus, which is hard because most of the evidence is reflected in the view of the consensus, and you have to be right, which is hard because the future is hard to predict. You put those two conditional things together and you figure out that macro forecasts have no value. Now, ask me your question once more, though.
I guess in particular, I was wondering how you think about the interaction between the macro and the micro. So
I just described it, and but so you say, well, Howard Marks said you need a macro forecast, so we're going to spend a lot of time developing a macro forecast. But remember, he also said you can't do it in a superior manner, so don't waste your time. It's not easy. There's a friend of mine, Richard Oldfield in England, wrote a book about investing entitled Simple But Not Easy. The things we do are simple, but it's very hard to do them correctly or in a superior manner. Roy? What else?
Next question.
There. Hi, Howard. Thanks for your time, and big fan of your Mastering the Market Cycle book. The question is, what did the last few years teach you about investor psychology, if any?
My approach to investor psychology is simple. I try to engage in an activity I call taking the temperature of the market. You can gauge psychology. You can say, you know what, I think everybody's pessimistic and it's overdone, or everybody's optimistic and it's overdone. You can't predict psychology. And if you think back, you look back at the pandemic, and on March the 20th of 2020, the S&P was down a third in the previous month, and everybody wanted to jump out a window. That was a Friday. On Monday, the 23rd, the Fed announced its program and gave some details. and expanded on some of the things it had said previously. And the market started going up. And everybody said, well, people are pessimistic. How can the market be going up? That must be wrong. And the market went straight up from there. As I recall, the S&P rose 62% from March 23rd to the end of 2020. Totally unpredictable. People were down in the dumps. A bunch of them thought that maybe what the Fed was going to do wouldn't work or something like that. But anyway, psychology went crazy. And the growth stocks and the FANGs and so forth went up, I think, 112% from March 23rd through the end of the year, and continued to go up in the next year. So I think you can diagnose psychology. You can treat it like a symptom, like a doctor does, and that can tell you, give you an idea whether psychology is too strong or too weak to be reasonable. But it's very hard to predict. And when you think psychology is too positive, which suggests that prices are too strong, and they're going to come down, I would say don't bet heavily on it, because Lord Keynes said the market can remain irrational longer than you can remain solvent. And so one of the things I like to point out to people is that we sometimes know what the market's going to do. We never know when. Because knowing when is a matter of knowing when psychology is going to turn. And we never know when. Any question, whenever I get a question which starts with the word when, I reject it. How can you predict when the things you think will happen are going to happen, when the main cause for their happening will be changes in psychology?
We have time for, do we have time for one last question, Howard?
Sure. Well, how about if I give shorter answers that we can do two?
Sure.
We're there, maybe middle row.
So what is the ideal behavior under the overvalued market? I mean, you explained that. My question is, what is the ideal behavior? How should we behave under the overvalued market? You explained that if the interest rate is low, cost of capital will be low, and also then the price tend to be higher than intrinsic value. And so under that circumstance, what should we act?
Well, I tend to suggest behavior based on the spectrum from aggressiveness to defensiveness. And each investor should have a notion for what is the right balance of aggressiveness and defensiveness for them. It's a personal thing, it's subjective, and it varies from one person to another and from one institution to another. So let's say you have a sense for that. Now the question is, today, should you be at your normal balance, or should you be emphasizing offense or emphasizing defense relative to your norm, whatever your norm is? And I would say today, look, the market has corrected. The S&P was at 4,800, and now it's at 4,200. Of course, within the last year, it's been at 3,500. So it's kind of in the middle ground. The PE ratio is a little high, but it's not ridiculously high. The outlook calls for a recession, but nobody says it's going to be a profound recession. I think that things are pretty. Oh, and by the way, it's really interesting. People say, you know what? This is a tough time. I don't know what's going to happen. The future is unusually murky, unusually uncertain. Well, I believe that there are two kinds of times. There's the time when the future is clear, and there's the time when the future is murky. The main difference is that when people think the future is clear, they're probably wrong. The future is always uncertain. And the belief that it's not, again, tends to get people into trouble because they become sanguine at a time when they should not be. But I think the future is unclear now. We're seeing this inflation thing, and we're seeing the super high deficits and debts of the U.S. and other countries. Plus, we have the geopolitical uncertainty in Ukraine and in China and so forth. I would be a little balanced toward defensiveness today rather than aggressiveness. And if you'd have to be quite creative to sketch out a very optimistic future for the next year, but don't listen to me because I'm incapable of it.
Edward,
Last question. Last question.
Howard, thank you so much. I wanted to ask you, what are the biggest mistakes that you've seen companies make around debt? And what do you look for in a company when you invest in their debt?
Well, the second question is too multifaceted to answer, or we'll be back to long answers. But the first question, which is, what's the big mistake people make? And people the companies that get into trouble, either can't imagine a negative enough scenario or overestimate their ability to succeed in a negative scenario. So, one of my favorite sayings for anybody who's read the memos is never forget the person who was 6 feet tall, who drowned crossing the stream that was 5 feet deep on average. The idea of surviving on average is a ridiculous idea. Like, well, that guy's a skydiver. On average, he's successful 98% of the time. It's not a good idea. You have to be successful all the time, which means, well, you have to survive all the time, which means you have to survive in the worst of times. And so, when companies overlever, it's because they overestimate their ability to persist in a negative environment. And then the negative environment comes along and they melt down. And I mentioned earlier, I got a little laugh with the fact that most of the LBOs that were done in the 1980s melted down, the prominent ones, Macy's and Federated and National Gypsum and US Gypsum, and just company after company went bankrupt in 91. Why? Because this was the first crop of prominent LBOs, and they were done with 95, 96% leverage, 4 or 5% equity. Leverage has the beneficial effect of magnifying your successes when you're successful. But it also magnifies your failures when you fail. And equity is the thing that permits you to get through the tough times. So those deals had too much debt, too little equity, and they failed. And, again, either the management says, our business can't go down more than 10%, then it goes down 20. Or they say, well, it could go down 20%, and it does go down 20, but rather than going down 60%, the profits go down 100%. So either the failure to foresee tough times or the failure to understand the difficulties that you'll have in tough times. And, in the old days when America had, I did a study when I was in college, which was a while ago. And as I recall, there were 21 American companies who were AAA. And that meant that they had these bulletproof balance sheets. But most people after that came to the conclusion that you don't need AAA. And if you can be rated AA or single A, that's high enough. And you still would have a very low cost of capital. So they took on more leverage. So 50 years ago, a bunch of companies made the mistake of having too little leverage. But the real mistakes come from having too much. And when you look at Silicon Valley Bank melting down or something like that, it's because, you know, banks have highly leveraged balance sheets, and if there's a loss of faith, they can't get through a tough time. So that's my answer.
Howard, we want to thank you on behalf of the INSEAD community for sharing your time with us. It was an absolute pleasure, and we are looking forward to reading your next memo. Thank you so much.
Well, I should have it out within the next week. Enjoy your studies and enjoy Fontainebleau. Bye-bye.